I genuinely believe that this book, The Most Important Thing by Howard Marks, should be a required reading for all investors. They should literally be handing out this book in business schools as students are walking in. That's how good this book is. And in this video, I will share and break down the 6 most important lessons learned after reading this book, The Most Important Thing by Howard Marks. It's also mind-blowing to think that there are so many things that Howard Marks talks about in this book that we have already talked about on our main money investing channel. If you don't believe me, ask any of our community members and they will tell you. And I promise you, after watching this video and reading this book, your perspective on investing will change forever. So let's get started. Lesson 1, price and value. Howard Marks, the author of this book from Oak Tree Capital, has performed incredibly well in the markets over the years. And he says the best foundation for successful investing is price and value. Knowing how much something is worth and having an accurate estimate of its value is the indispensable starting point. Now remember, price and value are 2 very different things. As Warren Buffett says, price is what you pay, value is what you get. In other words, value is what you decide something is worth. Price is what the market decide something is worth. Howard Marks says, in market, we say buy low and sell high. But what is low and what is high? It's a very vague statement, right? He says the idea is to buy below the intrinsic value, which is the low, and sell above the intrinsic value, which is the high. The opportunity comes in when the price of a stock is trading below the value so that we can buy the stock at a discount. We also have to remember that price we pay always determines our future returns. And Howard Marks says investment success doesn't come from buying good assets, but instead it comes from buying good prices. What he means by that is that if you overpay for an asset, doesn't matter how good that asset is, your future returns will be lower. However, if you underpay for an asset, even if it's not the best quality asset, your future returns will be higher. It's that simple. The price paid determines our future returns. And think about it for a second, right? Everything around us is worth buying if given to us at the right price. And Howard Marks says our job as investors is to find opportunities where prices are below the value. And we should constantly be on the lookout for deals. He says buying something for less than its value is the dependable way of making money long term. And he says, don't get sucked into the disaster cycle of market greed. That is what creates bubbles. And so stocks and assets go from attractive to attractive at any price as investors keep bidding it up and there is no regard to the price that it's trading at. And that is when the greater fool's theory also takes over and it can be very dangerous. Lesson number 2 is all about market efficiency. Now, if you're wondering how do we even get these deals in the first place, right? Why would the stock be trading below its intrinsic value? And that's because markets are not efficient. We've been told a big lie, believe it or not. That is to say that market is always right. Wrong. Markets are mostly wrong. And Howard Marks talks about efficient market hypothesis. He says that markets are efficient in a sense that all information gets priced into the market very quickly. So it's the speed and quickness to incorporate all information which is efficient, but not the price. That quick reaction from the market pricing information does not mean that it's priced right. Think about it. Who makes the market? It's you. It's me. It's your neighbor. It's the hedge fund guy on Wall Street. It's all of us. It's humans. And humans have emotions. So can we be wrong? Absolutely. Since market is an aggregate of all human behavior, most of whom are at the mercy of our psyches and emotions, humans can be wrong and thus the markets can be wrong. Many people will reach similar cognitive conclusions from their analysis, but what we do with that analysis will vary because everyone is influenced by psychology differently. And that's the whole idea of understanding that markets are indeed not efficient. He says that market prices are often wrong. They're often too far above or too far below their intrinsic value. inefficiencies are created by the market where prices move extremely above or below their intrinsic values. He says the reason why markets will never be efficient is because they're not traded by clinical models or machines or computers or spreadsheets. There is human involvement. And as long as there's human intervention, we are all driven by our emotions such as fear, anxiety, greed, envy, and other emotions that render objectivity impossible and open the door to significant mistakes. Lesson number 3 is about superior investing. Now that we know that markets are often wrong and there are deals and opportunities out there, how do we take advantage of them? Howard Marks says that superior investing is not just about beating the market, right? So beating the market is not the same as superior investing, which is a beautiful thing to learn. And superior investing is all about risk-adjusted return. And we will talk about risk later in the video as well, but Howard Marks says that high absolute return is far more recognizable and exciting than superior risk-adjusted performance. And that is to say that if someone says, I generated a 40% or a 50% return, we think to ourselves, wow, like that's a great return. But that's an absolute return. We have no idea how much risk was taken to generate that return. Risk-adjusted return is all about accounting for that risk and then understanding how well or how poorly did they perform. And superior investing is what Warren Buffett and Peter Lynch and Bill Miller and even Howard Marks have perfected over the years. And their style of investing isn't sexy or exciting like Cathie Wood's maybe. It's actually quite boring, but that's what makes all the difference. And their investing strategy is not focused on generating a higher return compared to the market. Their strategy is focused on generating a lower risk compared to the market. There is a subtle difference here. And the difference is that they invest defensively to protect against market losses, which creates both longevity and survival in the markets. And these are two very important elements for long-term investing success. You invest defensively long enough, and eventually markets give you the opportunity to go on the offense and generate high returns relative to risk. Put another way, these investors have found the right balance between risk, return, so that they make more money when the markets are up and lose less when the markets are down. And it is very important to lose less when the markets are down through investing defensively. And the defensive investor's main emphasis is on not doing the wrong thing, because it's very easy to do the wrong thing in the market. And defense investing is more about consistent base hits as opposed to swinging for the fences and trying to hit home runs occasionally. Howard Marks says defense investing involves having a margin of safety and avoiding losers from portfolios and also avoiding catastrophic years. It requires patience, finding bargains, good deals, second level thinking, avoiding pitfalls, and a splash of contrarianism. So let's talk about them one by one. So patient opportunism is all about being patient and letting the prices come to you. Does that sound familiar? Because it should, and that's been our money vesting mantra. Howard Marks says that you'll do better if you wait for investments to come to you rather than you chasing after them. At Oaktree Capital, they live by the philosophy that we don't look for our investments, they find us. He says there's no need to rush, there's no need to force trades or investments, be patient and let the right ideas come to you. Now, finding bargains is just being on the lookout for deals. Look for opportunities when prices are trading below your intrinsic values. Sid Cottle, who was the editor of the book Securities Analysis, said that investment is the discipline of relative selection. That basically means that in investing, everything is an opportunity cost. If we decide to invest in stock A, we give up the opportunity to invest in stock B, right? That's opportunity cost. So our job is to find the best deals that give us the most return with the least amount of risk. Now, when it comes to bargains, Howard Marks says, oftentimes the reason why an asset or a stock becomes a bargain in the first place is because it's out of favor. And it becomes out of favor because psychological forces and investors' fear that the recent price action drives the stock price even lower. So it's the recency bias which makes the stock price go even lower as investors start to run for the exits. And it's at that very moment that market inefficiencies begin and prices start to drop below their value. Now we talk about second level thinking, and Howard Marks says that superior investors have second level thinking. And this was also covered in the book Thinking Fast and Slow by Daniel Kahneman. And first level thinking is very basic and rational. And Howard Marks says that most people and investors remain first level thinkers where they connect simple dots from A to B. But second level thinkers have superior insight, intuition, sense of value, and awareness of psychology that is required for consistently generating above average returns. Howard Marks says that second level thinking is deeper and more insightful, and it requires a lot more work and practice. Second level thinkers are patient and they wait for opportunities, and during times of crisis, they execute on those bargains. Now, when it comes to contrarianism, the idea and execution isn't enough. They need to also be right. Howard Marks says that big money is made by having a non-consensus opinion and being right. And that is so true, because doing what everyone else is doing, in other words, having a popular belief and being right, you make average returns. Having an unpopular opinion and being wrong can be dangerous and lose you money. But having an unpopular opinion and being turned out to be right is where the big money is made. And second level thinkers have a sense of contrarianism where they understand when and why the markets are wrong and there is value to be captured. And finally, we come to avoiding pitfalls. Howard Marks says that superior investing also consists of avoiding pitfalls. Warren Buffett once said, an investor has to do very few things right as long as he avoids big mistakes. And avoiding big mistakes and pitfalls is the foundation of longevity and survival. And Howard Marks introduces the concept of failure of imagination. In investing, we extrapolate most of our decision making based on what has already happened. We look at the past for the clues to the future. And it can be helpful, give us a framework to work in, but our mistakes and losses in the market don't happen because of our lack of understanding of the past, but rather our failure of imagination of the future. That is to say that we can't prepare for what we don't know. Failure of imagination consists of not anticipating the possible extremeness of future events. And the essential first step is to avoid pitfalls by being on the lookout and thinking of outcomes out of the ordinary history. Understanding that there are other possibilities and outcomes which could take hold on the future, events that have never happened before. Example, COVID-19. And many of them could be disastrous for our investments. Which brings us to lesson number 4, the future is unknown. Howard Marks says investing is dependent on dealing with one thing, that is the future, which is largely unknown. We don't know what's gonna happen tomorrow, let alone a week, a month, or a year from tomorrow. That is exactly why superior investing is so difficult, because nobody can predict the future accurately, consistently. Consistency is the key word here, because you and I can be right about our future predictions, maybe once or twice, if you're lucky 3 times, but we will not be right consistently long term. And for this very reason, Howard Marks says, instead of trying to predict the future, focus on the present. He says that the market moves in cycles, and think of it as a pendulum swinging back and forth. On one extreme, we have the greed, the euphoria, the overconfidence, overvaluations, a lack of risk assessment. And on the other side of the pendulum, we have the fear, the anxiety, the uncertainty, the undervaluation, the panic selling, the lack of value assessment. Howard Marks says our job is not to predict the future, but to simply take a temperature of the market and understand where we are in the pendulum. We will never know how far the pendulum will swing on one side, how long it'll stay there, or when it will reverse back to the other side, but knowing where we are is enough to make smart investment decisions today. And that is such an amazing analogy, because it teaches us to really evaluate the market based on its merit and constantly do a risk-reward analysis to figure out where exactly are we in this market cycle and how the markets are priced, whether it makes sense to buy, sell, or hold. And now for the most important lesson, lesson number 5, risk management is everything. Perhaps the most important lesson from this book is risk. Howard Marks talks about risk extensively, so much so that he's got 3 chapters dedicated to just risk. He talks about understanding risk, recognizing risk, and controlling risk, and they all go in order. And the book offers such an amazing perspective on risk. And we have touched on this before, but Howard Marks says that superior investing isn't just about generating the highest return, but it's also about generating the lowest risk. And the reason why risk analysis is so important because, number 1, most investors want to avoid or eliminate risk. And number 2, when we consider any investment, our decision should be a function of both risk and reward. He also says that we often applaud investors who gained more than the market when it's going up, but never applaud investors who lost less when the markets are going down. And that was such a mind-blowing thing because real investment risk can't be observed or quantified or calculated. In simple terms, Howard Marks says, real risk is the possibility of permanent loss of capital, and much of this real risk is subjective, it's hidden, it's unidentifiable. He gives us an example of, let's say that you make an investment and it works out as expected and you make a profit. Does that mean that it was or wasn't risky? Who knows? Perhaps it did expose you to a great degree of risk, but it just did not materialize. Howard Marks says risk only exists in the future, and it's impossible to know the future. So dealing with the risk starts with recognizing risk in the first place, and he says the prime element of risk creation is the belief that there is no risk. So the saying that the risk is gone is perhaps the most dangerous sources of risk in the first place. He says investment risk comes primarily from too high prices, and too high prices often come from excessive optimism and greed and inadequate analysis and risk aversion. And so risk has everything to do with price. When everyone believes a stock is risky, it gets sold off to a price where it's not risky at all. Same is true when investors think that the stock price carries no risk and the price gets to such high levels that the risk increases significantly. Now, when it comes to controlling risk, Howard Marks says outstanding investors are a combination of their ability to both control risk and generate high returns. And you will never find a consistently successful investor only known for their ability to generate returns, because it's a combination of both. He says superior investing is asymmetrical, generating acceptable returns with a low degree of risk. And this is a very interesting psychological shift around risk, because the defensive investing strategy and value investing approach, which allows us to focus very much on the risk side of things, and the return will take care of itself. And think of it this way. A home in California may or may not be built to withstand an earthquake. We only find out when there is an earthquake. Otherwise, we have no idea. And just like that, investment risk is only seen when there is an actual loss. If there's no loss, it's not that it's not risky, it just means that the negative outcome did not occur. And outperformance comes in both ways, generating high returns and generating lower risk relative to the market. The only problem is the former gets a lot of fame and popularity if you beat the market and generate a high return. The latter can't be appreciated because it's hidden, it's subtle. And very sophisticated investors, only sophisticated investors can appreciate that outperformance. And Howard Marks says that the road to long-term investing success runs through risk control more than through generating aggressive returns. And it really got me thinking, and I was looking at Warren Buffett's returns. If you look at both Warren Buffett's and Cathie Wood's return, what is clearly visible is the presence of risk control by Warren Buffett and the absence of it by Cathie Wood. In up years, yes, Cathie may perform better than Buffett. Buffett even performs better than the S&P 500 in some years. Most years he's tracking the S&P 500, but it's during the down years, the bear markets, the crashes, when Cathie Wood gets destroyed and Buffett's expertise is revealed. And finally, we come down to luck versus skill. Howard Marks talks about the role of luck in investing. He says, once in a while, someone will make a risky bet on an improbable and uncertain outcome and end up looking like a genius. But it's important to recognize that the role of luck and differentiate that with skill. Much of investing is influenced by luck or chance or randomness. And that is because in investing, not all of our outcomes can be tied back to all of our actions. That's because there's so much out of our control. Investing is chaotic. There is no orderly fashion in which the markets move. So don't underestimate the role of luck when it comes to investing. Prudent, skillful investing takes years to practice and eventually master. He says short-term gains or short-term losses are very bad indicators of acute investing skill. So there you have it. That was the most important thing from the legendary Howard Marks at Oaktree Capital. If you enjoyed this video, make sure that you subscribe and of course, drop a like on this video. As always, I will see you all in the next video.